Switching on a light shouldn't be this complex. Neither should choosing where to invest your money. With Cinnabar Investment Management, we take the complexity out of investing, ensuring the right fund for the right investor every time. Cinnabar Investment Management. Complexity simplified.
Good morning, everyone, and welcome to our quarterly feedback session. We are delighted to have such a broad audience. Got an action-packed agenda filled with some great content and lots of different participants. So we're hoping you're going to really enjoy the session we have lined up for you today. And sorry, there we go. Just had to skip past the video. There we go. So I'm going to be the MC and the host for the day. I'm going to run through a few of the items that we're going to cover in the morning, and then I'll introduce the various speakers and the content. But just as a starting point, just to focus on Cinnabar and our purpose, the whole essence of what we do, why we do everything we do, is to create and protect intergenerational wealth. So it's not just about ensuring your own individual retirement goals and needs are achieved. It's to pass on wealth to future generations and secure the future for all future generations. That's our aspiration and our goal, and it's the reason we get up every morning to do what we do. As an outline of what we're going to cover today, we've got a great agenda lined up for you. It's going to start with Alex Cook, who is the CEO of Cinnabar. He is going to actually talk a little bit more about financial advice initially, and discuss some of the best kept secrets about how to guarantee your own financial freedom and achieve the financial returns and goals that you need to do. Thereafter, we've got a host, a various range of panelists representing Portfolio Metrics, who is a strategic partner of ours who assists us with effectively some of the fund manager research and creating what we call our asset allocation chassis, which sort of basically is the core of how we invest. And what Brendan and Brandon are going to discuss with you today is how we as a team and a group structure our investments and the theory behind how we invest and why we do what we do and how to ensure that we achieve the goals we need to. Thereafter, we've got Geoff Blount, who will give us an introduction to effectively the Cinnabar investment philosophy. Geoff is the head of investment strategy at Cinnabar, so he's closest to that element. Thereafter, I'll do a quick update. Sorry, I didn't even introduce myself. My name's Hugh Napier, to the Cinnabar performance. And thereafter, the tour de force will be Phil Bradford, who's going to give us a market overview and a review of the world around us and how this relates to how we've structured and positioned our solutions and portfolios. Alex will then close. So as a start, I just wanted to sort of give a quick touch point on where Cinnabar fits into, if you like, the ecosystem of financial advice and wealth management. So as a sort of as your wealth manager will do, they'll assist you in understanding your needs, classify your risk profile, build and select an investment portfolio with you. And the investment management of that really centers on and sits with a discretionary fund manager. Cinnabar technically is a discretionary fund manager, but we pride ourselves in spanning both the financial advice and investment management side of things, where we try to help product selection and ensure that the appropriate product is selected for a given advice process. So with that context, you can see why the structure of our presentation today starts with that financial advice section. Alex is going to run through that and a tool which helps us to understand risk and needs and requirements and outcomes for your investment returns, and where Cinnabar then is an adjacency and a touch point to that. So, sorry, just a bit of finger trouble there. So with that, I'm just going to stop sharing and let Alex run through a section here on how to guarantee your financial freedom.
Thanks, Hugh. Good morning, everyone. Welcome to today's session. It's the biggest session we've had to date. The number of people that have registered has really been astounding, and we've opened the session up to both wealth managers, financial advisors, as well as their clients. And we'd like to encourage everyone for future sessions. Feel free to forward the invite to whoever you think might find the sessions useful. So what I'm going to be touching on today is financial freedom, and the title is quite interesting. The best kept secrets. I don't think they're secrets. They just can be fairly difficult to apply without discipline. So first of all, financial freedom, what is it? That is the point at which you no longer need to work, the point at which your assets are able to sustain you from an income perspective. So that's the point that most of us would like to get to. Unfortunately, only about 6% of the population will achieve this status, and this is not just a South African phenomenon. It's really a global problem that exists. And although this is the reality, it doesn't have to be. We very, very firmly believe that within 20 years, anyone who is employed and maintains employment can achieve financial freedom, a point at which they do not have to work. Absolutely anyone. But as with everything worthwhile, there's a price to pay. So there's a price to pay for achieving this financial freedom. And this price to pay is to understand the secrets and then apply these secrets. So today, what I'm going to be doing is I'll share a program that most financial advisors and wealth managers who use Cinnabar within their advice process also employ, and that is a program called WealthBit. So let's see if it shares. Is it coming up? Okay, wonderful. So just to give you an overview, what we've loaded here is an example of a client. We've loaded a dummy client, and their full name is Cinnabar, Cinnabar. The surname's Abar. And this is their dashboard. So the initial dashboard looks like this. They're 55 years old. They are retiring at age 65. Their capital projection looks like it's going to go up from their current 7 million to around 20 million at retirement. And then it keeps on going up for a little bit and then falls off a cliff. This is in future value terms. In present value terms, which is after inflation, which makes a lot more sense to all of us, this is what it looks like. So you'll start off at 7 million, and then the buying power will increase to around 11.5 million, and then it falls off a cliff. Now, because it falls off a cliff, the income that this client can achieve at retirement is, well, 52,000, which is what they want. And that carries on until age 82, and then there's trouble, real trouble. So because there's trouble, this safe retirement status is all the way on the right, on the left-hand side, and it's in the unlikely position. So the person's unlikely to achieve a safe outcome. Interestingly, and this is often quite shocking, but the amount of income that we'll need post-retirement in nominal terms often surprises us. So at age 82, this person who needs 52,000 a month will need a nominal value of 251,000 a month after tax. So it's worth bearing that in mind. Okay, so this is the situation that that the client finds himself in. If we had to take a look at the assets that this client has, they've got 4 assets here: a retirement annuity, a provident fund, a unit trust, and offshore investment. The asset allocation for each of these is quite interesting. So the retirement annuity, you can see that's fairly well diversified: domestic equity, offshore equity, domestic bonds. So that looks fairly well diversified and looks like they're targeting a reasonably good growth. And the same is true for the provident fund. The unit trust, here it looks like they're quite conservative, where domestic bonds represent 60% of this unit trust and domestic cash 30%. The offshore investment, very heavily invested into offshore bonds and offshore cash. And the result of these asset allocations for each asset is a total asset allocation graph, which looks like this. So the chart looks like this, where everything from the purple to the right is offshore, everything from the green to the left is local in South Africa, and the amount of cash and relatively low risk investments is quite high, with domestic bonds of 24%, offshore bonds of 13%, and offshore cash of 16%. So this is what the person's situation looks like, and it's not good. Unlikely to achieve a safe outcome. The projected capital retirement is 11 million, and to be safe, this person needs about 16 million. The realistic income that this person should be drawing is about 37,000 a month versus the 52,000 a month that they would like to draw. So let's take a look at the first of the secrets, and we're only going to touch on 3 golden rules or 3 secrets today, and we'll start by implementing or testing a new scenario. And in this new scenario, we're going to go to the first golden rule, and that is, so you'll see there's another line. That darker line is a scenario line. Also, whatever change we make, we'll see the impact of that change. The first golden rule is to look at the budget. So this person has been quite diligent. They've done their budget, and the budget has come out at 52,000. They've replicated this budget of 52,000 to their retirement budget. So they've said that's one and the same, but that's not true, because if we expand their essential expenses, we'll see that their rent or their bond repayment is set to continue when they retire. And this is something that must not be true. So we'd like to settle that bond by the time that retirement happens. And you can see their budget reduces from 52,000 down to 42,000 a month. And let's update and use the detailed expense, the revised detailed expense. And we can see the impact of that change just by doing an accurate budget. All of a sudden, the amount of capital the person needs reduces all the way down to 13 million from 16 million. And we can see the capital lasts a bit longer, to the point where the income, instead of stopping at age 82, now extends all the way to age 89. And the safe retirement indicator goes all the way to possibly from unlikely. So that's the first golden rule and the first step. The second golden rule and the second step is to really understand risk. Now, doing your risk profile is essential in doing planning after you've done a budget. And many of us are quite keen on taking as low a risk as possible. And what we're guaranteeing by taking almost no risk is that we're not going to achieve the required return. And I know money markets at the moment are offering sort of 8, 9, some 10%. However, on an after-tax basis, you end up with 5, 6, or 7%, which isn't enough of a return above inflation to achieve your desired results. So when you look at risk profile, the risk profile is made up of 3 components. The first is the required risk. How much risk do you need to take to achieve your desired objective? The second one is your capacity for risk. And this is how long you have until you need to use the money. Now, many people think that when you retire, you need to use your money then. But that's not true. When you retire, if you have sufficient capital, the majority of your money you won't need to use for many years after you retire. So you can afford to actually achieve or to target a higher return on your capital. And then the third component is how you feel about risk, how you feel about losing money from time to time. And nothing will be a straight line. This is another price to pay. The price to pay for achieving a certain return objective means that there will be volatility from time to time, and we need to be comfortable and embrace that. The most important component is the capacity for risk. So the capacity for risk is how much risk you can afford to take based on how long you have available to leave the money invested. So this person's risk profile works out to being aggressive on the whole, which means that they're targeting a return objective of 5% above inflation, above CPI. And we've set CPI at 6%, which is around the long-term inflation that we've had within South Africa, and plus 5 would be 11%. So let's go back to our assets and take a look at those 2 portfolios that we know were out of kilter with the risk profile. The first is the offshore investment, where this was the asset allocation. So let's update that, and rather than specifying a specific return rate, let's use our overall risk profile and target a return of 11%. Update that asset. Let's do the same with this unit trust with that asset allocation, and go for a more appropriate asset allocation locally. And you can see that these would have changed. So now the offshore is majorly majorly invested, if that's a word, into offshore equity, and the unit trust locally as a large portion of domestic equity, and it has more offshore equity. The impact of just those changes the overall asset allocation markedly. Whereas it was heavily invested in domestic bonds, the domestic bond exposure decreases. It had a low exposure to domestic equity, that increases. Offshore equity was 9%, goes up to 32%, and offshore cash reduces from 16 down to 1.9. So a fairly significant asset allocation change just by changing two assets. And the result, if we go back to the capital graph, is that the capital, which is this now the dark line, the scenario capital line, looks like it stands a high chance of lasting for the balance of this person's life. And the safe retirement indicator has moved across all the way into the green there, where they are likely to achieve a financial freedom, where they will not need to work again. So that is the third golden rule, and that's really aligning the asset allocation to the risk profile. So what we then do is simply implement the plan. That then becomes the person's new plan once that asset allocation change has been implemented. So everyone can achieve financial freedom. It really, really is possible. And these are 3 of the most important rules. Prepare a budget, and that budget should be done every single month. Make sure the risk profile has been done, and be comfortable with that risk profile. Embrace that risk that you're taking, and then align your asset allocation to the risk profile that you need to take. So I hope this has been useful. I hope you enjoy the rest of the session, and I'll catch you again towards the end of the session.
Thank you, Alex. That was fantastic. It's by chance, I think, a perfect segue and introduction into the section that Brendan's going to share with us, which is appropriately titled The Anatomy of Outperformance. Brendan is the SA Head of Research at Portfolio Metrics, and effectively is responsible for, as I described it, that asset allocation chassis that underpins our investment philosophy and how we manage and run our money. Brendan's going to take you through what is, I think, a very interesting case study, really, of sort of asset returns in a particular sector. And he's going to show you and lead into a section which Brandon will then cover on investor behavior. But kind of like the theme of the secrets that Alex described to ensuring your financial freedom, this is the secrets that underpin investment management and how you ensure that you don't trip up around what is often a very noisy and disruptive market environment. So with that, Brendan, thank you for joining us today, and we look forward to hearing from you.
Thank you very much, Hugh, and thanks, Alex. I appreciate the opportunity very much. I firstly just want to apologize for the pilot headphones I've got on. That wasn't intentional. Having a bit of audio difficulties, but at least I can hear you. And hopefully you can hear me.
Loud and clear.
Excellent. All right, fantastic. So yes, Hugh, as you're saying, I want to be talking about performance, but more specifically outperformance, and that's relative to peers. But it's going to be more of a philosophical discussion, really, and it's hopefully going to tie into and relate to what we're going to be discussing further on in the presentations as well. So I'm going to be using real data, but then also talk a little bit about philosophically how you can generate good long-term outperformance. And I think kind of the conclusions that we get to is not necessarily what one would think. So it's really just kind of peeling away at that onion to understand really what kind of attributes you need in order to do relatively well over the long term. Now, this is something that I think is extremely important before we dive into kind of the analysis, is the fact that strategic asset allocation is incredibly important in order to generate long-term performance. And this is something that we talk about often, and that's because it is just so important. And really what the slide is saying is that ultimately over the long term, over 92% of your performance and risk drivers is driven by strategic asset allocation. Stock selection, tactical asset allocation, calls, and other things is almost meaningless when it comes to the long-term performance and ultimately the long-term results of investors. So I think really what's important there is if you go to a fund manager's presentation and they're talking to you about this stock and that stock, and it doesn't necessarily tie into how they are building their portfolios from an asset allocation perspective, what this is saying is actually it's just noise. And so strategic asset allocation is extremely important for those long-term drivers of returns. So really what I want to do is boil this down to first principles thinking, and speak about the fundamental truths, or at least what we think are the fundamental truths as to how you can actually find yourself building out portfolios that do what they need to do over the long term. So what we've done in this analysis is we had a look at the multi-asset high equity ASISA category. Essentially what ASISA does is they look at all of the funds available in the South African space, and they try and put them into categories where they ultimately trying to do similar type of things. They have similar type of mandates and kinds of asset classes that they invest in. But really this multi-asset high equity, I'd say, is pretty much any fund manager would be putting their flagship fund into this category. And so it's really competitive, and it's a really important category, and I think it's kind of where the bulk of sort of pre-retirement and then even post-retirement assets sit as well. Now, just going through some of the asset classes and constraints that you have within the space. So within the high equity category, or this balanced type of space, you can go up to 75% in equity. So it's got quite a strong risk budget to take within equities, and you need to have a minimum of 60% within there as well. It's also possible to take up to 25% in property. And now this is a really important point here, because I think going up into 2017, you would have found that there were a lot of balanced funds out there that came very close to sort of maximizing that 25%. And that's a very strong asset allocation call. And I think as sort of history unfolded, they would have realized that that was quite a bad asset allocation decision, and they would have blown holes in their portfolios by taking such a concentrated and strong bet in what's ultimately a very illiquid and concentrated asset class. And what you'd see now is that a lot of balanced funds don't actually have even close to those kinds of weights in property, but be as it may, you are able to take up to 25% in property. And then you have the opportunity to take up to 45% offshore. Now, that's not sort of dual listed stocks like a Richmond that's listed on a JSE offshore. That's proper offshore. You're able to actually externalize assets and buy your Facebooks or your Apples or your Microsofts or your Alibabas. If you like, you can actually externalize that. And this was something that was recently changed, where we got an additional 10% offshore. So that gave balanced fund managers a little bit more opportunity to take a little bit more of an asset allocation change. And it's been very interesting to see how these balanced managers have actually interacted with us. Some people have taken that offshore capacity, some people haven't. But ultimately what that means is there's less of a constraint, but really what that also means is that there's probably more variability in returns too, likely. Okay, so we looked at the multi-asset, or this balanced space, over the last 12 to 13 years. And just purely from a performance perspective, we kind of ranked them on cumulative performance going back over these 13 years. And you can see here, the best performing fund cumulatively generated a return of almost 270% over this kind of 13 years. The worst performing fund generated a cumulative return of just over 100%, 104% to be exact. And so the difference in performance between the best performing fund and the worst performing fund is actually quite stark. So, I mean, the worst performing fund on an annualized basis kind of gave you an inflation type return of around 6% per annum. And your best performing fund gave you a return of 11%, so an inflation plus 5%. Now, really the difference when you look at it cumulatively is 160% difference. And what we're actually going to do now is we're going to have a look at, okay, what are the attributes of the worst performing fund, and what are the attributes of the best performing fund. Now, to do that, we're going to break up the competitor space into quartiles. Now, essentially what that means is the top quartile managers are the best 25% of managers in the space. So to make it easy, if you've got 100 competitors in a space, it'll be the top 25. Okay, the second quartile would be the next 25, and so on and so forth. And the last quartile, the fourth quartile, would be the worst 25 managers that happened to be alive over that period. And when I say happen to be alive, it's actually really important, because survivorship is something that actually biases a lot of the statistics when you do analysis of this. And so when I say these are the guys that survived, there's only around 60 managers that survived over this period. There are lots of managers or funds out there that have kind of fallen into the I guess, forgotten graveyard where I guess some fund managers have intentionally just stopped their funds because they've just performed so badly. So this is like almost the cream of the crop. Even if you're in the bottom quartile, you've actually still survived. So what we're going to do now is we're going to break up this universe, okay, of the best 25% managers, the second best 25%, and then third and fourth best 25% managers, and look at it at sort of different time periods and try to see here, okay, do we have some sort of a trend here that we can pick up? So what I've done here is I've broken up this universe on calendar years. So for 2011, this number that's over here, so I don't know if you can see my cursor over here, but this 2011 number is just showing you here. The worst manager performed, I think it was -4%, and your best manager gave you around 18%. But I think what's really important and what's really interesting over here is the variation of returns for the bottom quartile, so the worst 25% managers, and also the variation returns of the top quartile, so the best 25%. And so actually, if you have a look at a variation of -4 to +18, okay, that's 22% difference. But if you look at it to all the other calendar years here, it's actually pales in comparison. Now we have a look at a year like 2015, was really a busy year and had a lot to do with China. Actually, they decided to debase their currency during the year. I think that was in July 2015, and that really hurt emerging markets in South Africa in particular. But also what happened towards the end of 2015 was Nenegate. So our president at the time, in his wisdom, decided to fire our finance minister and put in our weekend special, Des van Rooyen, and markets did not take a liking to that at all. There was extreme stress, particularly in our bond markets, but then also in our equity markets and in particular financials as a sector. And you can see there, when there's a lot of stress in the markets and volatility out there, the variation of returns between the worst manager and the best manager becomes quite stark. So I remember quite well, there was a manager called Third Circle who just got their positioning horribly wrong. They were in financials, got caught out by this Nenegate thing, and literally just blew up their funds actually. And they would have been probably even worse over here, because they would have been close to -100%, but they didn't survive, so they're not in the database. Yeah, but anyways, so you can see when there's a lot more stress, there's a lot more variation in there. In 2018 is also a good comparison, because that's when the Fed first tried to start increasing interest rates as well. It was a difficult period for emerging markets too, as the dollar strengthened. There was a little bit of jitters, etc., etc. But I think it's really important to just point out there is quite a big difference between the worst manager and then the best manager of the worst lot, like the fourth quartile. So when you say, like, I was at the top of fourth quartile, it's not necessarily all that bad, but you don't really want to be at the bottom of that. And then you have a look at the variation as well at that top quartile too, is quite a bit. But I think what's really important, and what I really want to point out here, is that variation is quite large in the bottom quartile. And what we have found out, and what we've kind of discovered, because we've kind of managed money now throughout this period, is a lot of the guys actually that find themselves at the top of the pops over here quite often find themselves at the bottom of the pops as well the next year or the year prior. So you need to take a lot of risk in order to generate those returns, to either be right up at the top or right up at the bottom of the fourth quartile. And unfortunately, in the asset management space, is a lot of people actually incentivized to take those kinds of risks, because people want to be at the top. There's headlines that are generated from that. People talk about it. Certain advisors are attracted to those kinds of performances, and they say, hey, look, this manager's done the best in the last year, I'm going to put my money there. But what that portfolio typically has is it's pregnant with a whole bunch of risks that they've taken that don't necessarily play out over the long term. They're quite cyclical and they move around, and so you end up with a return that is very, very violently moving between bottom and top. The second thing I wanted to point out, or probably the third or the fourth thing, is just how tight those second and third quartile bands are over time too. So you've got huge deviation between the first and the fourth, and then you've got 50% of the managers in the space that have very, very tight performances between them. Now, ultimately, and you'll see this as I'm going to give away a little bit of what I want to say, but from our perspective, we don't necessarily want to be taking these big risks, these big sort of factor type of bets that you need to take in order to be top of the pops. And then ultimately what's going to happen is you be at bottom of the pops. But we want to just kind of muddle along in the middle. So our target space is actually to be kind of average, actually, in the second and third quartile, even top of fourth quartile. If we can do that quite consistently, you're not necessarily going to be all too far off from that long-term performance of 11%. I mean, you can see here the top of third quartile in this 1 year actually generated a return of 20%. So okay, let's assume that this is our target, all right, and this is what we're trying to do. What did the best manager, so the manager that generated that return of inflation plus 5% over the long term, that 13-year period or whatever, on an annualized basis, how did they look on a calendar year basis? And you can see here is they were actually quite consistently hitting the dead average space. So even in 2016, they were in middle of third quartile. In 2018, a period that I mentioned, they were bottom of the fourth quartile. 2022, they were also, again, bottom of fourth quartile, et cetera, et cetera. But what you can see from these dots, they were never top of first quartile, but also they were never bottom of fourth quartile either. So quite consistently in the middle of the pack and doing okay there or thereabouts. But ultimately, as I showed you in the beginning, what that did is it compounded into a cumulative return of 260%. These are the worst managers. So of those, I showed you the very worst manager generated a return of just about 6% around inflation. Cumulatively over that time was around 100%. But here you can see these worst managers, okay, on an annual basis, calendar year basis, you can see quite often they're finding themselves in the bottom of the fourth quartile. So not only are they hitting the bottom of the fourth quartile, it seems that they're doing this quite consistently. So they're taking quite strong bets, and the bets that they're taking, they're getting them quite wrong. But I think what's also quite interesting is sometimes they do hit up right up to the top over here as well. So that's kind of what I was mentioning, is sometimes you can take really strong bets. You're talking to a very charismatic manager they're talking so eloquently about their views of the world and how they think the world is going to pan out, et cetera, et cetera. And so they've so convincingly positioned their portfolios for that specific view. But guess what? It doesn't pan out the way that they thought, because ultimately forecasting things and trying to predict how the world is going to work, or what's going to happen in the world, certainly over the next year, is extremely difficult. But these kinds of managers have such high conviction in what they're doing, and they put a lot of big bets in their portfolios in that. And ultimately what they're doing is they are way more confident, or way too highly confident, in our opinion, in their views of the world. And so they end up blowing up holes in their portfolios and finding themselves too often at the bottom of these quartiles. Yes, every now and again they also shoot up to the top, but too often in the bottom. So those were calendar year returns, and what we're looking at over here now is on a 3-year annualized basis. Okay, so we've taken the time horizon and moved it from 1 year, and now we've just moved it to 3 years. And again, what I wanted to show here is, okay, so there's a bit of a play of what I've done. So if you have a look at the y-axis, so these variations of returns, you can see it moves from 50% to minus 40% in the calendar. In the 3-year, it actually becomes a little bit tighter. So it moves from minus 15 to 30%. But also, if you have a look at this green dot too, where you find it sometimes in the 3rd and 4th quartile, and actually not doing fantastically well sometimes in the calendar, but not doing spectacularly badly, you can see that green dot kind of moving up now in that 3-year performance. So as we move through, and I'll take you through now to the 5-year annualized number. As we move through those kinds and increase that time horizon, what you'll start seeing is the green dot of the best start moving up the kind of the rankings. And really, it's almost like the cream rises to the top kind of phenomena. Is you, on an annualized basis, you kind of compounding this almost average return. Okay, not too good, not too bad. But over long periods of returns, if you can manage to avoid the big losses, ultimately, you're able to compound those things, and it starts becoming quite meaningful, longer term type of performances. So now I'll move again to the 5-year number, and you can see again the y-axis has adjusted again from to minus 10% and 25%. But here you can see again is this green dot has actually moved now even higher into still kind of like middle sort of lower end of the top quartile, but you can see again it's moved up to further up that quartile basis. And then if I add the since inception number, look, this was by design. You can see ultimately the best manager that compounded these kind of average returns on an annualized basis ended up being right up at the top, and those managers that were hitting too far down that bottom quartile were ultimately the worst performers over that 13-year period. So this is what's resulted in this high equity managers that have the ability and are putting in quite a lot of risk in this portfolio. I mean, they're able to take up to 75% in equities, and over time equities should pay, but ultimately the worst manager generated only inflation. Best manager outperformed them by 160%, but without taking massive risks in order to get there, and actually compounding kind of dead average returns in the shorter period. So if we have a look at this anatomy of outperformance and hopefully I've taken you through like how this has played out for that best manager, I think one of the sort of most important things from our perspective, and when it comes to building solid performance and solid portfolios that ultimately need to produce returns that meet the client's objectives, a lot of it has to do about a very good defense, winning by not losing, keeping out the good ball when Alan Donald's coming in at you and he's bowling those big induckers. A very, very strong defense ultimately is something that compounds over time. And I think there was something that Warren Buffett said around the rules of investing, and he said the first rule is don't lose money, and then the second rule is don't break the first rule. Those are the only rules. What I forgot to mention is when you had a look at that best performing manager in the calendar years, when they did perform badly, it was kind of around that 0%. They didn't actually lose money. So winning by not losing and being able to compound that over time makes a very, very big impact on portfolios. You need to measure and reduce single factor bets. Now that's very fancy words, but ultimately what I'm trying to say is you need to take bets where you think they can be rewarded. Taking a big bet on the rand isn't necessarily going to reward you. It takes a bit of a random walk. It's very difficult to call, and to get it consistently right is very difficult. The same thing can be said for the gold price, for argument's sake, or the oil price, or even trying to predict where the economy is going to go. Inflation. interest rates, etc. Taking these kind of major bets, and even worse, positioning for that, can make your performance very erratic. And we're also skeptical as to whether you can get them right on a consistent basis. Getting your asset allocation is extremely important. Diversifying across a broad range of risks. And when I say risks, I mean, ultimately, you're able to extract sort of systematic or fundamental risks from different asset classes, like a fixed income, it would be credit or duration. So interest rate risk, ultimately. When you move into equity, you're taking equity quite risk type of risk. You're looking for that growth. If you appropriately diversify across those risk exposures, make sure that you don't take any single factor bets and betting on things where you probably not going to be able to get them right, like the oil price, is a good way to achieve more consistent returns over the long term. Compounding that consistency year in and year out, again, winning by not losing, not taking massive bets, being a little bit more humble in the bets that you are taking. It's like, look, listen, I don't actually know, so I'm going to spread my bets across there. But you know what? I'm going to spread it so that over the long term, I can meet my clients' investment objectives is kind of the way to go. Be skeptical of people that have a very strong view of the world and then also have high conviction, and they speak so confidently about their portfolios and how this stock is going to perform so extremely well, and they're so convinced of it for X, Y, and Z reasons. But also, why is consistent performance important? And I think this is so critical when it comes to the ordinary investor and also a financial planner and a financial planner's business. Is how and why is consistency, and why does it mean so much to people in the advice space, and ultimately, how does that translate into a good outcome for ultimately the investors that are investing with financial advisors? Number one is it helps you navigate uncertain markets. Ultimately, markets are always uncertain. It's very difficult to forecast, and I've been at pains to mention you can't forecast many, many things, and we are consistently dealing with uncertainty. It feels like now we're dealing with even more uncertainty, but actually uncertainty is the markets are pregnant with uncertainty always. So it helps us kind of navigate these uncertain markets to try and build these robust portfolios that are consistently kind of not losing money, winning by not losing. It fits so much better into a financial plan, and this is so critical. Financial advisors take their clients through a process. They figure out, okay, what is the return that we need in order for you as an investor to reach your retirement goals? Ultimately, you need to live off a certain amount of money. You have a certain amount of expenses that you need to pay, and your portfolio needs to be able to transcend that time horizon. So you go through a financial plan, and it's absolutely devastating if you put it into a portfolio that finds itself too often in the bottom of that fourth quartile and blowing holes because it's taking these huge risks within the portfolio themselves. So we're looking for a predictable risk experience, okay? We're looking to build portfolios that are efficiently put together in order to have the highest probability of achieving the investment objective of the end client. Ultimately, we're in the game to try and help our clients reach their investment objectives. And also, very importantly, we want those returns and those risks that are taken to meet with the investor's sort of financial personality, their ability to take on risk as well. And ultimately, what we're wanting to do for the financial advisors, and what Cinnabar is ultimately trying to do, is limit those uncomfortable client conversations where you're trying to defend somebody who's taken these massive bets and they've blown holes in portfolios, et cetera, et cetera, et cetera. We're just trying to compound almost dead average returns over time, but we want to do it consistently. But really, that is very, very difficult to do, is what I'll leave you with. So I'm sorry for talking for so long, but that's all I have to say for now, and I will end my show.
Perfect. Thanks, Brendan. I appreciate that. That was a fantastic tour de force, and sort of it was, for me, the highlight is the essence of the cream rising to the top. And what's actually quite neat is, I think it's quite a nice segue, because coffee and cream are always analogous with being paired well, and the principles and qualities of coffee often relate to strength. And one of the elements of strength, I would argue, is investor behavior, and having an incredibly patient, steadfast, and trusted financial wealth manager to guide you through the journey. So with that said, I'd like to introduce Geoff. I think you're one section early. We're going to have Brandon from Portfolio Metrics is just going to do a quick chat on investor behavior. And from that, we will lead hopefully into the investment philosophy, which should build on these discussions. And Brandon is the CEO of Portfolio Metrics and has a little bit of wisdom on financial markets. And we really appreciate your time, and thank you for joining us. And we look forward to your section. Thanks, Brandon.
Thank you very much, Hugh, and thanks for the opportunity and for everyone's time. I'm going through the most stressful part of any presentation right now, which is just the hope that the screen saving actually happens. So someone can let me know that my slides are visible.
You're good. Okay,
all good. What I've chosen to share here, Hugh, and to everyone else here, is a presentation that I gave a year or two back I gave it in Dublin. To the financial planning board there, and the advisors that are part of their sort of chartered financial planning sort of community. And the purpose of this was to actually move away from the focus on the investment managers, the provider of returns, and to evaluate the role of the advisor in the partnership with the client. And what I actually seek to show is that the asset manager is quite often the junior partner in the outcome. And Alex right in the beginning talked about the risk of ultimately not meeting goals. So we often formulate risk in terms of market volatility. You get a Ukraine, you get a COVID type event, and you get these big drawdowns in portfolio. And we typically look at that as risk. But shortfall risk is fundamentally the bigger risk over time. So these are risks that actually accumulate over 30, 40 years. And quite often we underestimate how pivotal the role is of client behavior, and obviously the role of the financial advisor as coach. All a financial advisor has to do over 30 years is just get a client to avoid one or two bad decisions. And apart from all the other things that advisors do, you earn your fee multiple times over. All right, diving straight in. Here's the picture. Investing is very, very easy, contrary to what Brendan's saying. Brendan's it's not easy. I'll say it's easy. All you have to do right here is when markets are expensive, you sell. All right, so you sell expensive assets and then you buy them back when they're cheap, because markets are and they're a little bit irrational, and they give us an opportunity to go and buy cheap things and sell big things. And really, in other words, that is the holy grail of investing. And if we can get that right, of course, we are going to not worry about shortfall risk at all. We're going to be very, very comfortable in our retirement. And again, to pick up on Brendan's sort of theme there, we do have asset managers and individuals and investors who have a high degree of confidence that they are able to do this. But in fact, it's a little bit easier than done. And I think I was asked to do this presentation because I started in financial markets at the end of 1993. So I've seen this movie, I've seen season 1, 2, 3, 4, and 5, and all the episodes. And it's a bit like Scooby-Doo. It's got the same sort of theme. All of it just plays out in slightly different ways. It could be an emerging market crisis, dot-com crisis, financial market crisis. It can be, as I said, the more recent crises. Now, what actually happens is one enters the market, and if you're lucky enough, you enter the market when things are going well. You're optimistic at the outset. It turns out that you've made some great decisions, so the excitement comes and you start feeling the benefits of real wealth, right? And say, geez, I've worked hard for my money. I've worked in a job or as an entrepreneur my whole life, and it's hard to make money. And all of a sudden, I appear to be making free money. I'm sitting on my bum and I'm watching my investments, and I'm just going up. And ultimately, it gets to a point where we're euphoric. And then comes that day where there's a little bit of bad news, and you're not too worried, but anxiety starts creeping in. and this downward trend develops a bit of momentum. Now, as we start putting our blinkers on a little bit, and we're in denial, but we're still pretty solid. We are still in our strategic plan, and lo and behold, this trend continues. And now a little bit of genuine fear starts creeping in, because you start worrying about whether those long-term retirement goals are going to be achieved, and there's genuine sort of anxiety that just starts building there. At some point, we get depressed because we've got less money than we actually put in, and markets continue down. Now we start hitting the zone of panic, right? So our emotions have actually got us in our grip. Our brains are less in control, and our emotions grab us. And capitulation is the point where we run out of our capability of holding on to that idea. So at this point, we probably go and do something else. We go and change our minds. We deviate from strategy. We come up with something else. We've consulted with our neighbors and all of those things. And then we despondent because we got half the money. Now I'm exaggerating. It's not always half, but we've got less money than we started off. And we've got no possibility of doing anything else. Desperation, because I'm not going to be able to retire. I'm going to work for another 10 years until the day I die. But then we start getting that little light at the end of the tunnel, and we start hoping again. And then we start getting relief and ultimately optimism again. So this is a roller coaster of emotions that investors are exposed to. Now, I did a little exercise here. Now, this is a hypothetical investment over 10 years. I generated these things in Excel. There's a little way you can randomly generate returns. But what I've plugged into it is the kind of expected return we might get from certain equity investments. And then I also introduced an element of risk that is typical for that class. In other words, the kind of annual variations that you might get from the stock market if you remained fully invested. Now, presented with this graph historically, so one is sitting with your advisor, and we look at this graph, and you say, well, I put in $100 or $1 million or $10 million, and it became $300 or $3 million or $30 million or whatever. So threefold increase. Now, most people will look at this and say, yeah, that suits me. I could do that. I can see it's a little bumpy, and but I can manage that. I mean, I'm the kind of guy or girl who can, sit out those periods. But in reality, right, this particular path that I pulled out, which involved a threefold increase over 10 years, at one point involved a 36% drawdown. So you were sitting there with money, and you can relate it back to the roller coaster of emotions. You're looking at your investment statement, you're feeling good about the world, confident, optimistic, and then you lose 36% of your cash, right? We go through our whole cycle of emotions, and it starts looking good again. We've just about got back to where we started, and we get smashed by another 20%. And if we hold on, right, ultimately we get to our 300. Now, the truth is, and academic research will show you, certainly people in the room, you might have experienced it personally. If you're a financial advisor, you've certainly seen on multiple occasions, not everyone actually survives that -30 and -20 emotionally. And not everyone has enough composure to hold on. So the truth is, the markets were able to give you a threefold return, but the investor was only able to achieve that had they actually been participating in the market over those periods. And it is very, very difficult. So here's my picture I put up earlier with all these, this roller coaster emotions. But there is that center zone, which we can literally need to focus on, which is the risks of fear, desperation, anxiety, panic, and capitulation. And I'll tie this a little bit into something that Brendan said earlier, and I'm going to use it as a little bit of potentially a crutch or a mechanism for helping us navigate these somewhat risky zones. So what the evidence suggests is, contrary to the holy grail of investing, where it's really, really simple, where you just buy cheap assets at the bottom and you sell them when they're expensive. And if we all could do that, I promise you there would actually be no issue with financial sort of achieving financial goals over the long term. The evidence is that we do the exact opposite, that we tend to buy on the euphoria, the confidence, the optimism, the observation that our neighbors and fellows and people at the golf club or whatever club, bridge club, whatever club we're part of, they're making money, and we tend to have the confidence to make those decisions at what ultimately turns out potentially to be exactly the wrong time. And again, we are swept up in the, there's a lovely picture that Hugh had. I just wasn't happy with his pixelation. You know, the photographer in me was kind of a little bit offended by the pixels of the lemmings, but he had a lovely little picture there of lemmings going flying over the cliff. And that's what happens at the bottom there. Now it says repeat until broke in the slide. The scary thing is you don't have to repeat it too often. You know, the kind of idea is if I keep on repeating the silly thing for, you know, 10 times, 20 times, I'm broke. You only have to get it wrong once, twice, 2 or 3 times. 3 times is broke. But if you have to get it wrong once during a COVID or a Ukraine or whatever, the likelihood of achieving those long-term goals is heavily compromised. Right, but how severe are the consequences? This is a nice little picture. The S&P 500, not everyone in the room will potentially know what that is, but a lot of you will. That is just essentially like the equivalent of the all-share index in America. So this is representative of all stocks in the market. And all it's showing you is what the returns were. Okay, there's the time period, July 1980 to 2008. That was just before the financial crisis. And it's not that I picked those dates. I just happened to have this picture handy. But it shows that if you were invested for the full period, now I'm just guessing there, it looks like you made 8.75% per annum. And that's if you're fully invested. If you only missed the best 10 days of a period of 28 years, so think about that, it's almost 3 decades. If you were not invested for the best 10 days, and quite frequently the best 10 days will come after the worst, the longest night. So the longest, darkest night generally produces the best 10 days. So if you've managed to, there's a loss of composure, there's a capitulation, I'm getting out of this thing, I don't know how low it's going, and when things improve, I'll look at getting back into the market. But all you had to do was miss the best 10 days to go from an average of 8.75% to under 7%. Now, that little difference of 2% might not look like a lot if you're looking at 1 year, but compounded every single year over 30 years as an extraordinary difference in wealth. And I think this was what Brendan was saying, is if you're a manager, for example, and you do slightly better than average most of the time, only slightly better, you will be the top performing manager over the long term. And the same holds true for investor behavior, is little lapses in composure that lose you potentially 8% per annum on average, compounded every year for 30 years can be extraordinary. Now we just go and take something a little bit further and say, but what if I miss the best 20 days in over 3 decades? Now I'm down to 5.5%. What if I miss the best month? And right now we're down to just over 4%. You're actually got returns that are almost half of what one might have been. So what we have then is something we call the behavior gap. So on the left, we have the investment return. Now, what that actually means is the investment return available to investors, or through our lens as investment managers. What do we have to work with? What are the ingredients for the recipe, as Phil often talks about? What did we have available to make the best of? Now, the investment returns available were on the left-hand side, and potentially we can augment that through some smart, judicious management and by building robust portfolios. But what did the investor actually get? And that investment return is the one on the right, and the gap is the behavior gap. And we have seen this in South Africa so many times. In my sort of 30 years of being in this market, I have seen celebrated managers, celebrated funds that were top of the pops for 5 years or 10 years. The funds accumulated enormous assets. And when the sentiment turned and the panic set in, those funds lost assets. Sometimes they lost 3/4 of their assets. Ultimately, the performance of those funds turned. There was a recovery. And if we look at the performance of the fund over a 20-year period, it was not that bad. It wasn't too bad. But if we look at the performance that was achieved by investors, it's a very, very different number, because a lot of the investors weren't there for the recovery because they crystallized loss in the downside. And I guess we're talking about these things because the world, and Brendan used the word pregnant, the world is pregnant with risks. This is a zone of high uncertainty and the easiest time to capitulate when we read about war in the Ukraine and all of these kind of things. So in conclusion, this little picture, there might be, you don't have to be an investment person in the room, but if you did maths at any point in your life, or you're an engineer, you'll understand the point I'm making. So the lifetime return for an investor is the investment return that you actually achieve that carries you towards your retirement. And as Alex said right in the beginning, your ability to cover your needs with a little bit of luck, get some of those things that you want, and then maybe beyond that, your wishes, those kind of dream things. So it actually fundamentally affects your ability to live the last multiple decades of your lifetime in a situation where you've got choice. Where do you get it? Part of it comes from what markets are able to offer, what Cinnabar are able to do in terms of the assembler of the returns. So Cinnabar's responsibility is to take the returns available, assemble it, and make it available to them and the advisor. But the big plus here is investor behavior and why we've got squared in here. So in other words, a square makes something bigger, 2 squared is 4, 4 squared is 16, etc., etc. Investor behavior squared. Now, this is not a real equation, okay? It's an illustration. But the illustration is that the role of investor behavior and the coaching from a trusted advisor ultimately plays a bigger role in financial success than does the role of the asset manager. And actually letting that sink in is quite important, because we tend to focus on the asset managers if they're the only element of the equation. The advisor's role is potentially bigger, and the investor, in terms of engaging with the advisor, ultimately will drive that lifetime return. Right, and that's all that I've got. Let me just stop sharing. There we go. Hugh,
Thank you.
handing it back to you.
Thanks.
Thanks for
Yeah,
listening.
Brandon, thank you. That was fantastic. I really appreciate that. And, you know, as always, hugely insightful. And it sort of leads into the introduction of Geoff Blount, who's head of our investment strategy at Cinnabar. And hopefully this is going to be what I would call our most steadfast and reassuring section by design, because it's hopefully going to rephrase what Brandon sort of concluded with, give you investment choice at the end of your working careers and in retirement. So I'll pass over to Geoff to discuss, you know, what our investment philosophy is at Cinnabar, how we manage money, and you'll start to see the themes of consistency, meeting peer average returns, and delivering on that mandate, to use Brendan's analogy of the cream rising to the top. So thank you, Geoff, for joining us today. And I'm going to run the slides. So there might be a little bit of up and down, and Geoff might yell at me on occasion, but that's okay. It's all part of the process. So let me just get my screen up and running. And
very pleased to be here while Hugh is just pulling up the deck. So I just want to talk through how Cinnabar then takes, let's call it the theory, and Brandon very eloquently introduced some of the theory around investing, which we fully subscribe to, and how that then flows through into a practical application. Obviously, you've got theory and analytics, you know, that now has to come into a philosophy, which Cinnabar then applies in building the portfolios. So if we could just skip to the next slide. So, you know, I think there's a few interesting notes to make. You know, the one is there's the concept of what ultimately produces the returns for the investors. You know, Brandon spoke about, you know, investor behavior and what markets give. Now, I want to show this slide here. It's an old chestnut, and I think that many of you will have seen this. And as financial planners, you would have seen it set in many conferences where people say, well, you know, the ultimate determinant of your long-term return is your strategic asset allocation. In other words, what is the general fixed blend of equity, property, bonds, local, offshore, cash, etc., and what is your fixed reference point in your portfolio that you're constructing for a client, obviously to meet the client's risk objectives. And, you know, and across the Cinnabar range, you know, we've obviously, you know, we've got various funds, and each fund has a strategic asset allocation. So in fact, sorry, if we can just go back one, Hugh. So if I had to just highlight over, or call it 91, 92% of clients' returns ultimately come from what that strategic asset allocation is. And each Cinnabar fund has a strategic asset allocation. The balance, 8%, 8.5%, actually comes from some of the tactical tilts, maybe some stock selection. And that talks very much to Brandon and Brendan's comment around actually stick to your knitting. Don't sell high, don't buy low. At the end of the day, if your strategic long-term asset allocation says that this client in this risk profile at this age should be in have a general 65% exposure to equity. Stick to that. If the market goes up and down, doesn't matter, just stick to that. There can be some small tactical tilts around that, but at the end of the day, that's your strategic point. So how does that work in the world then? If we can go forward one, Hugh. The way Cinnabar sees the world really is starting very simplistically and saying, forget equities, bonds, cash, property, etc. Just what do we think are growth assets, assets that over the long term will comfortably beat inflation and offer wealth creation, and what are defensive assets, assets that don't give us higher returns but don't lose as much money. And our starting point in looking at strategic asset allocation is to say conservative investors need more, for example, in the income funds, obviously need more defensive assets, 100% defensive assets, and obviously in Reg 28, more aggressive clients need, within the cap of the Reg 28, the maximum exposure to growth assets, typically equity. And we know that this profile means that the more risk you take over time, the greater the return you'll earn over time. Hugh, if we can go forward. So you'll see here that in practice, the return structures of the Cinnabar funds have behaved the way we want to. Now, obviously, this is a snapshot in time, and certain times they slightly change depending on your measurement period, if there's a big market correction or crash. But generally, this is what one should expect. And let's call it a 7% in our income fund through to, say, a 15% typically expected annual return in our balance fund. And this does change over time. So you can see here that in not deviating too far from your strategic asset allocation, you then start creating this flying information and you start getting to know what your returns will be. And I'm going to talk about in a moment what I call our funnels of certainty, which actually demonstrate this. The second aspect then, if I can bring forward Hugh, the next one, is not then just the strategic asset allocation, which helps you determine your longer term returns, but then what starts happening with the little tilts around that in, as Brandon said, a very risk controlled, diversified fashion. In other words, we've got our strategic asset allocation. How can we through the tactical asset allocation, small bets in asset classes away from benchmark, through to small, through to manager selection, through to making sure that within the actual stock selection, that there are small tilts that are winnable tilts that don't introduce undue risk. And this is just another way of demonstrating what we say, the range of returns in the peer group versus the average. So the thin bar, as you can see, is the range of returns from the best to the worst manager. The red bar is the average. And then you have the Cinnabar, which is slightly above the average return. And the point being here is, as Brandon explained, if you can build a philosophy that just consistently gives you that return without putting you too high or low, over time you do rise to the top. So if we pull this together, what we've got is strategic asset allocation, and then we have the extra 8% that you want to try and do just by tilting the portfolios by our choice and by what the managers introduce to give you a more known return. So what are the funnels of certainty over time? And this is how the whole two things pull together. If we can go forward one. There's 4 slides, and I'll go through each one quickly. But simply to explain the slide, some of you may have seen these before. What we've taken here is the peer group range of returns for the best and worst over the last few years, over the last 5 years. And this is what did the worst manager do over 1 month and the best manager do over 1 month. And that's the widest range of dispersions. By the way, we've annualized that number. So that's not that in 1 month the manager lost 80% of your money as an income fund manager. It was the annualized return of the worst month for the worst manager. But what you can see here is that the range of returns goes in the short term on a monthly basis, minus 75% annualized to plus 250% annualized. This is an income fund. But if you did that measurement over a quarter, the dispersion narrows over 1 year, 3 years, 5 years. And generally what actually happens is by 5 years, across any of the asset classes or the fund structures, your range of returns between the best and the worst manager is quite narrow. It's still quite large because this graph is a little bit deceptive, but it gives you a much narrower range. And what this means then is that while you might live, and that goes back to Brandon's comment about the psychology of investing, while you might have near volatility in the 1 month, quarter, 1 year periods because performance is all over, actually over time, certainty, this funnel of certainty forces returns closer. And what you want to just do is the middle of the pack and just slightly above the pack. And most of the funds, in fact, the funds do achieve that. So you can see here, just in income, even in the income space, which is low risk, the funnel of certainty ranges from -75 to 250, but in the long term settles at about 7%. If we go to the next one is just a stable fund. So it's a moderately conservative fund. And the range, even in this space here, -100 to +200, but it settles in the long term around 10%. If we go to the next one, balanced portfolio, again, massive range of returns, -100 to 350, but it does settle again in that much tighter range, again, driven by your asset allocation. And then finally, just the balanced plus fund, which is the high equity Reg 28. Short-term annualized monthly vols or returns, nearly -100% and nearly +850, but settles at about 15% in the long run. So you can see the importance of strategic asset allocation, sticking to your knitting and not trying to buy high and sell low. And that applies not only obviously to equities, but for fund managers that are outperforming or underperforming. So we've now created a strategic asset allocation framework. We know where we want to go. We know that we don't want to take small tilts around that. How do we do that? And if we can go through just to the next slide, Hugh, to the asset allocation slide. So obviously there's a blend of a few things at play here, which we'll unpack for you. The first one is what is our defensive and growth asset allocation strategically. The next one is within that is what would be the managers that you use to achieve that. What were the asset classes that you can use that? So if you actually look here across the time, for example, this is the Balanced Plus Fund. The asset allocation actually does change, and this is, but it's marginal changes relative to what the strategic asset allocation is, a fixed reference point, as well as what the managers are doing in the portfolio. Now, how does this change over time? Hugh, if you go through, remember both in the direct managers that we're using, as well as the managers that we're blending within PMX, you can see that there's a variety of managers. I don't want to dwell on this. Most of you are obviously very familiar with the point and the objectives that we're trying to achieve. But by doing this blending, you're also mitigating your risk. Interestingly enough, here, look at this amazing lineup here in the global equity fund on PMX's side. And so where this all pulls through together, and this is what I just want to finally show you, is the layers of risk diversification. So again, reverting back to Brandon's comment about diversifying risks, take bets that you can get a reward for. Obviously, so here is a strategic asset allocation. Our balance fund at the moment is 81% balanced plus fund, 81% growth, 19% defensive. But let's look at then how that's made up of. Within that, you can now actually see within the growth assets what is equity, what we refer to as real assets, property and the like, and what would be flexible assets where the managers can take quite aggressive tilts. But what makes that up? Now, this is like I'm peeling the layers of an onion. Is you then go and say, okay, well, across that, well, what is equity? Is it South African equity, developed market equity, emerging market equity? What is real estate in South Africa, listed property in South Africa? What is global property? What is SA fixed income? And now you can start seeing, and now on top of that, we go and actually look at the managers. And now you get a really interesting feel for actually how these layers of risk and return are developed to just make sure that both that your tilts around your strategic asset allocation just create marginal value and you get rewarded for those returns. And with that consistency, the objective is, as Brendan showed in his anatomy of outperformance, is you just want to try and be consistently, I don't know, just above average. Sometimes you're going to be below. You don't want to aim to be at the top, and you don't want to aim to be at the bottom. And with that, I think Hugh's now going to take you through the analysis of the performance to demonstrate just somehow how this has come through and come out in our portfolios.
Wonderful. Thanks, Geoff. Thanks for taking us through that.
Thanks.
Great set of slides. Let me just, sorry, I've just got a mouse issue. There we go. So I'm just going to run through a quick performance update, all building up in great anticipation for the tour de force with Phil. So thank you for that, Geoff. So just from a performance perspective, I'm going to run through about 4 or 5 slides. I'm not going to talk at too much length about the details of how we unpack our performance, but what I want to discuss is our framework for how we report. So linked to the discussions we've had, obviously asset allocation is the cornerstone to it. So a lot of our thinking around attributing and understanding our performance relates to not only our decisions of allocation to risk, but within risk, how have we performed and delivered on that mandate of generating a return. So what we often compare our returns against are inflation, which is obviously the real sort of negative impact on long-term investment returns and power of spending. And equally well is, have we performed in line with peer groups and or our own internal benchmarks of return in terms of, if we have a mandate to deliver on a certain type of return and risk profile, how are we doing relative to that mandate which we express as a benchmark? Sorry, just one sec. There we go. So I've got some graphs after this. You don't have to peer too closely at the screen, but this is just a snapshot taken at the end of March, which shows basically the fund returns on the top bar is of inflation per period of quarter and year to date would match because of the current calendar year. The rolling 1, 2, 3, and 5 year numbers. How have the peer groups, the CISA sectors performed? How have our Cinnabar funds performed? And then to do the obvious maths underneath that, we simply subtract the Cinnabar fund performance from either inflation in the second row or from the peer sector averages to determine whether we are on track with our intent of beating inflation consistently and increasing. So that links to the mandates. So the mandates of our fund range increase with an inflation return. For example, you have a CPI plus 1, 2, 3, 5% inflation beating return over the appropriate rolling periods. Similarly, how have we done versus peers? And there you can see, with respect to inflation, we have exceeded inflation with the exception of the rolling 1 year number, which is well understood and documented with regard to the hyperinflation we experienced in 2022. So it was very difficult to meet and exceed inflation in that period. But over the longer periods of time, if you take the 5 year number, you start to see the more steady state returns, which all talks to what we've discussed today on staying invested, being consistently invested and exposed to your risk asset classes. This is just a quick snapshot, deliberately short term, just to discuss the quarter, but it's visually quite clear to show what the intent is. This is the quarterly excess returns of our solutions versus inflation and the peers, which is in line with what we are always targeting and hoping to achieve. Jumping gears a little bit, those were the local funds. We do have a global balanced fund. This shows the lineup of underlying holdings and funds within that fund. And what I wanted to bring to your attention, if you were in our last quarterly feedback session, you will have seen that 2022 was quite a rocky year for most global funds. And there was nowhere to hide really, because there was a correlation between both equity and bond returns where they both had negative performances. So there was no sort of shelter from equity drawdowns. And furthermore, some of our investment strategies were punished, if you like, in that period, relating to that block of those first 3 funds, which relate to more thematic tilts towards world technology, developing world equity stocks, and sustainable energy plays. And there was a huge temptation, even within the investment committee, to capitulate in that sort of trough of despair, as Brandon described. And the good news is we've held fast, and year to date, there's been a very strong recovery. And then as diligent investment specialists, we have started to trim those positions in line with the recovery to move towards our steady state strategic asset allocation. But we did have the patience to wait for those recoveries. This is what I alluded to right at the beginning, is we look at our sort of fund returns with regard to both the strategic asset allocation framework, which is what Geoff described, get your asset allocation and risk profiles right. Do you make tactical tilts to or away from that based on broader macroeconomic or market cycle changes? What active managers do you deploy to deliver on that mandate? And then how do you deliver on that through effectively building blocks of your growth and defensive allocations? We compare then our returns, as I've already shown, relative to inflation, ASISA sectors, and our benchmarks. So in terms of our growth building block, this is again just the quarter. We've got other longer periods, but just for the sake of this presentation, focusing on quarterly performance, you can see the contribution to performance of the various elements within that building block, which relate to some passives, which are Satrix, MSCI World ETF, and Top 40 SA Top 40 fund. Both have done well. The global performance is predicated more on rand depreciation than global equity runs. And then the incremental returns gained from our emerging market plays, the portfolio metrics, SA equity building block, and Centaur, which is one of the funds we invest into. So all of those have contributed towards performance. If there are questions later, we can delve into longer periods of time and other contributions. Out of interest, looking a little bit under the hood, I alluded to those three aspects of our strategic asset allocation, our tactical asset allocation, and then our implemented solution through both passives and active managers. And this is just a 3-year back test of what we're calling long-term, really relates to our strategic asset allocation. But if you were to only implement it using passive instruments, the second bar is if you had our tactical asset allocation, where you have allocations with slightly overweight SA equities versus global equities at the moment, how would that return have played out if implemented only through passives? And then the far right-hand bar in burgundy shows your current holdings. Effectively, if you were to have invested in our current active and passive manager mix, what would the return have been? And it happens to show a nice picture where the current holdings are, in terms of our active manager component plus our passives, have outperformed passives only. But we actually don't mind if that shifts in any direction. It's a lead indicator for our investment committee, and always our yardstick of moving actually towards your long-term strategic asset allocation, but picking the best managers you can. And that's why we've got the backing and backbone to have an extensive fund manager research capability, as well as allocating appropriately to your risk assets. In the defensive building block, I'm not going to discuss this too much. In fact, I think Phil might be chatting a little bit about the sector, which he's quite familiar with, is just to show a similar chart where we've got basically the underlying components that we invest into. We invest into different ratios on the right-hand side. Let me guide you. Sorry, I don't have a pointer, but my plan, Saffron, Portfolio Metrics, Dynamic Income, and the Portfolio Metrics SA Bond Fund are allocated to in different proportions as you increase in risk across our fund range. And what we just use as a yardstick is to see how they've performed relative, for example, to a call deposit rate. But that's not always the best benchmark because they have different mandates, but it's just a measure of how they're performing and whether they're on track. The art really in this space comes to how you blend and match those risks and understand duration of bond exposures and yield curves, etc. but this is just a pleasing picture, which you would expect. Linked to one of those funnels of certainty charts that Geoff showed is obviously in a lower risk sector, you always generally expect positive returns over longer periods. I mean, the 1 month was the one that was negative. This is over a 2-year period, but just to show the consistency of returns of the various components. Just because some are lower than others doesn't mean that's wrong or bad. It just means it's often linked to their mandate and whether they should be taking on more risk or not. And that's what we sort of examine in our investment committee sort of section. So that was a quick update on the sort of fund performance. I wanted to create a little bit of time, which I think we've done, to give Phil, who is the SA Head of Investments at Portfolio Metrics, to take the stage and the floor and hopefully entertain us. Thank you, Phil, for joining us.
Thanks, Hugh. Can you hear me okay?
Perfect.
Excellent, thanks. Yeah, so Hugh's given me the task of very quickly giving you an update of what's happening in the entire world. Be quick, do it in 30 minutes, and be entertaining. So at best, I'll probably get 1 out of 3 right there. But let me jump ahead, otherwise we're going to run out of time on the 30 minutes. So there are a couple of principles I'm going to talk about, I think, and I'll come back to them just now. And a lot of them are actually quite linked to what both Brendan and Brandon have said around behavior and what we can expect and what we see from markets. But importantly, it's been a 5 bumpy years in the last 5 years with markets. You know, we've been through a lot in terms of COVID, in terms of what we saw last year. But to be honest, that's pretty normal. It's not unusual for us to have volatile markets. And to be honest, if it wasn't for volatility in markets, I don't think there would be a need for asset managers, because it would be a quite nice, easy game. But really what we've seen over the last few years, if you look at 2018, 2019, 2020, and then as we roll through to 21 and 22, we've seen that the winners haven't been the same every year. We had a very strong period, if I roll back a little bit again, of global equities had a nice little tailwind for a few years, and then pretty much came unstuck in 2022 when we saw risk assets come down. And then year to date, we've actually seen global equities bounce back again. I mean, US equities did very, very well for a decade or so. They did very poorly for the 10 years before that, which I'll come back to in a moment, but they've come through very strongly. The point is, obviously, every year's winners don't always remain, and really the good or bad news gets factored into the price quite quickly. But I'll come back to all of that in a second. What we have seen year to date, though, is the rand has weakened quite a bit. And in fact, today, this morning, at one stage, we were nearly at 19 to the dollar, after just pretty much a year ago, just over a year ago, been around 14. So there's been quite a significant divergence, specifically around South Africa versus other emerging markets, which I'll come back to in a second. So the problem we've got, and as investors and in terms of talking to clients a lot, the temptation is that, well, if we know what's going to happen in the future, then we'll be able to get things right. So, you know, I've just come back from presenting at a conference in Cape Town for 3 days, and fund managers were up there all the time, and everyone was talking about what's going to happen with the US CPI, what's going to happen with interest rates, what's going to happen with earnings, what's going to happen going forward. And the irony and the paradox of that is actually typically, even if you know the future in markets, you don't actually always know the future. And what I'm getting to with that is that very often, even if you look backwards, what you would have thought how markets would have reacted is often the opposite, and let alone giving you a good steer. And let me give you an example of that. So if you went back to the end of 2021, you know, there's a top analyst from Morgan Stanley, Mike Wilson, who's seen as a bit of a guru. You'll see him a lot on Bloomberg and CNBC, etc. And he came out with a forecast at the end of 2021 saying it's going to be a terrible year for equities going into last year. He said S&P 500 was going to fall to 4,400, and markets, you must watch out for markets. And I thought, oh, well, that's pretty interesting. Now, interestingly, he was right, but not right enough, because the S&P 500 fell to about 3,600. But then I looked back and I said, well, you know, why was he saying that at the time? At the time, he said, well, what you've got to do is you've got to short inflation-linked bonds. Okay, which actually did very badly, which out of interest in an environment where inflation was picking up was an interesting forecast. And then secondly, he said you must go underweight US bonds as well. Now, normally, which was, of course, the very right thing. Last year, we had the biggest sell-off ever in US bonds and global bonds around the world. South African bonds, ironically, actually did relatively well, but that's another story for a little bit later. Then I looked a little bit further and I said, well, geez, that's amazing. If he thought that inflation-linked bonds were going to do badly in an environment where inflation was going up, because inflation-linked bonds are the one thing that do well, surely, when inflation goes up. But actually, the reason he got his forecast right was he thought commodity prices were going to come off the boil and inflation was going to drop. Because of that, he said the inflation-linked bonds were going to do badly. So he thought inflation was going to drop, and he thought growth was going to slow down, and he thought inflation was going to be relatively benign. Now, that's the exact opposite of what actually happened. So here's a good example of a forecaster that was given a huge amount of credit for calling the market right. But the reasons he got his calls right on the market were actually because he's got his economic forecast exactly wrong. And the point really is that markets factor into the price things very differently. So if we go back to 2022 as an example, commodities were up, and this was to the end of September, but it followed through to the end of the year. Commodities actually did really, really well. So the Morgan Stanley analyst thought commodities would do badly, and he thought inflation would be relatively benign. Now, interestingly, the dollar did very well. Now, normally in an environment where inflation is going up, particularly in the US, you would actually expect your currency to depreciate. And the one asset that did really well was the dollar. You would expect it to have done the opposite. You would have expected gold to do really well. And ironically, gold now, year to date, is now hitting all-time highs. Last year, it got slaughtered. And inflation-linked bonds, which is the one asset class that profits from inflation going up, got absolutely slaughtered. So inflation-linked bonds fell 20% at one stage. So how did you lose money on an asset that was supposed to be doing well? So if you'd gone back to 2021 and you'd said to me, inflation's going to go up, it's going to be higher than expected, I would have bought gold. I would have sold US dollars. I would have probably bought Japanese yen, which did really badly. So how do we get these things right? And then, well, who else does forecasts? Well, here's the Fed committee. Now, these are the people, the committee in the States, that decide on global interest rates. They really decide on the future for a lot of the rest of the world because everything else is priced off US interest rates. If you went back to December 2021, and these are the people who decide where interest rates are going to be. They said by the end of 2022, US interest rates would be sitting somewhere between 0.5% and 1%. If you went forward in March, those same people had changed their minds and they said, actually, you know what, interest rates are probably going to finish the year around 2%. So quite a big difference. Now that's 3 months later, and they've massively changed their mind. So they're kind of driving the car forward by looking at the rearview mirror, and they changed their minds quite quickly. Then if we went forward from March to September, they said all of a sudden that rates were going to be roughly around 4.5%. And the irony is now we're actually at 5.25%. So the very people that decide on where US interest rates are going to be are often the worst people to ask. And this is not an isolated incident. I've seen this consistently over time, that actually the Fed committee, the people who decide on interest rates, are the worst people to ask. Because even if they think interest rates are going to come down from here, they can't tell you. It's a bit like the energy minister in South Africa saying, don't worry, there's not going to be load shedding. Don't turn on your heater in winter. So they've got to be careful what they project. So really, when it comes to investing, you can worry about getting the economic forecast right, or you can worry about focusing on making and managing money, because very often the exact opposite happens. And I'll come back to all of this again a little bit later, because I've got a good example in South Africa right now. So I was also looking at this recently, and one of the challenges we've got is I think often the expectations for investment returns can be very, very high. And a lot of us grew up in an equity environment from the 80s, the 90s, and the early 2000s when investment returns were very, very good. But if we look over the very, very long term, and this is of all the stock markets around the world, typically your best performance is roughly around 10% a year. Here's having a look at the S&P 500, the 500 largest stocks in the US over the last 30 years to the end of 2022. And you can see your average return was just over 9.5%, so just under that 10% mark. So that's closer to the longer term average for US equities. But the average investor in the States, just ironically, and most investors in the States actually manage their own sort of pension. They get involved quite a lot, and unfortunately, they tend to do a lot worse than the markets over time, ironically, and they tend to make behavioral errors and get in and out at the wrong time. They still did better than inflation and interest rates, but they could have done a lot better. Then if we go even longer, and if we go back over the last 122 odd years, ironically, South Africa is back again as the top performing stock market in the world over that time. So over 122, 123 years, the best place you could have put your money was actually South Africa. Now, obviously, the world was very, very different if we go back over the first sort of 90 years of that. But in South Africa being a commodity-driven economy, a commodity-driven market, did really well. And in fact, if you go back to the 80s and the 90s, we had 100 gold stocks on the JSE. Now we don't even have a gold index anymore, and most of our gold companies don't do much mining in South Africa. They invest elsewhere. But here you can see America actually did 6.4% above inflation. So realistically, over time, you're pretty lucky if you can get anywhere near 6% above inflation from equities. Importantly, if you compound that over time, you can create enormous wealth. But that world of expecting 20% a year is very unrealistic and not what you typically get over time on average. And then if we look over the last 15 years as an example, you'll see that returns have actually trended downwards, and I'll show you why a little bit later. You can see this black line here shows the average asset allocation portfolio in dollars has given you a return over the last 15 years of about 6%. The best return actually you could have had would have been US large cap equities, which has actually given you 8.8%. That would have been the best thing you could have done. And I've included for 2008 on purpose, by the way, because it's very, very easy to start returns from 2009 and ignore some of the bad years too. So through the good and the bad years, actually the best thing over the last 10 years was large cap equities. The previous 10 years before that, actually, they didn't do very well at all. But importantly, here, you developed market equities only gave you 2.3% over the last 15 years on average. So South Africa, what's happened here? Well, actually, SA equities have had, despite being the best performing market in history, actually had a pretty poor period. This is over the last 8 years. It just happens to be the period during we've been managing fixed income and particularly our dynamic income strategy over this period. So this is why we often look at this data period. And interestingly, the tortoise has beaten the hare in South Africa. You'll see that both bonds and then in the income space where we operate has actually given you a very, very decent return over that time. Sadly enough, though, SA equities have struggled, and the SA equity market has changed dramatically over that time. It's very, very concentrated now, ironically, in something like Richmond, where a few years ago it was predominated by resources, and it's moved back and forth into Naspers and out. But actually, SA equities have been a bit disappointing for South African investors, and this is one of the reasons why other asset classes have started to look more and more attractive, I think, to us as asset allocators as well. But I'll come back to it a little bit later. So the return expectations have actually been coming, or returns have been lower than you would have expected for many, many years. And one of the key reasons for that actually is we've had a very, very long downward trend movement in interest rates and inflation, which has an impact on equity returns, etc. And this, when I say very, very long, here's a 700-year chart of interest rates. And interest rates and inflation, as I mentioned, go very much hand in hand. You can see that over time, yes, there's been ups and downs in interest rates, and a lot of the noise over the last year, everyone was going, oh my gosh, we're going back to the 70s and the 80s again when interest rates were in their double digits around the world. But actually, that wasn't really normal. And what you will notice is that there's been a long-term downward trend. And actually, interest rates where they are right now and inflation actually are kind of back to their sort of longer-term average trend. And the key drivers of interest rates and inflation over the longer term tend to be productivity, and I'm talking labor productivity. So as we've got more things like technological productivity out there, it means that there's less jobs and workers around the world. There's less chance for people to contribute to from a labor perspective, which just means that it hurts economic growth a bit, and it pushes inflation downwards a little bit as well. Demographics is crucial. So the big change that we've seen since the sparking inflation that we saw from after World War II with the baby boomers is we had a huge population surge over this period, and we've seen more old people than young people in this trend subsequently since the spike of inflation right into the late 70s, into the 80s. And that's been driven a lot by demographics around the world. There's a lot more older people than younger people, and that just pulls economic growth downwards more and more over that period of time. So just keep that in the background, that the real super long-term picture is still not one of a hyperinflationary environment. So the key risks that everyone's been worried about has been going into 2023 was energy supply, cost of living, rising inflation. But as I've shown on that previous slide, actually, it's the kind of thing we just need to be a little bit cautious about, because it's a current risk, but we need to decide, is that going to be a future driver of investment returns? Importantly, the inflation tide is starting to move downwards. Yes, there's noise and there's some persistent inflation in the system right now, but inflation is a growth rate. And eventually, you know, if prices went very high last year and stay exactly at the same level, inflation effectively becomes zero, because inflation is a growth rate. So really what we're seeing at the moment is we're seeing inflation around the world coming out of the system. You can see here, this is showing the UK, which has been, you know, it's hard to believe that in our lifetimes we would have the US, the UK, and the Eurozone inflation much higher than South Africa's inflation, but that's exactly what we've seen in the past. But from base effects alone, you're seeing energy prices much lower than they were year on year, commodity prices lower, and the like. So it's just causing inflation to come down, not coming down as fast as everyone hoped, but that tide is still moving in that favor. And I often like the tide analogy, because the tide is moving in direction, waves come and go in and out, but the tide is still moving in a downward trend from an inflation and therefore an interest rate perspective. And importantly, asset valuations are lower than 2021. And the observation here is that in the outlook at the end of 2021, the world outlook was pretty good. Everyone thought growth was going to continue, that the risk environment was pretty benign. We've got COVID behind us, but that's actually when asset values tend to get high. And the easiest way to lose money in investing or to make mistakes is to invest too aggressively when the outlook is good. Ironically, the best time to invest in history has typically been when the outlook is worse, because simply assets tend to be cheaper at that time. And the most important driver of your investment returns tend to be the valuations that you buy assets at. Year to date, we've seen South Africa lag its peers. We've actually seen emerging market currencies do relatively well versus the dollar. The dollar was very, very strong last year. As it started to relax a little bit this year, the dollar tends to do very well when the world is in a panic state, and it tends to weaken a bit when the world moves into a sort of a more normal type of state as the world starts calming down a bit. But sadly enough, South Africa has actually lost out. So here's South African bond returns year to date to the end of Q1. I'll give you some more updated returns in a moment. You know, the income for bonds out of South Africa was pretty good. The capital is even okay, but the currency's pulled back. And that was to the end of March. You know, the rand has weakened quite a bit in the last few days again. So South Africa has stuck out, as I'll show you in a moment, as a currency that's actually starting to underperform some of its peers, which creates risks as well as a bit of opportunity potentially. Now, there's been a lot of noise in the press around, you know, foreign investors selling South African bonds. For those of you who've been following it, and it's obviously an area that I cover quite closely. Importantly, though, the amount of bonds that South Africa, that foreigners were holding of South Africa, reached a strong peak, 2015 and then back into 2017. But after that, once we got downgraded to sub-investment grade or junk, we've slowly seen foreigners sort of steadily selling out of our bonds. But they still own about 26% of our bonds. 26% of 3.3 trillion rands worth of bonds is actually still a lot of money. But importantly, South Africa, we're just a small part of the rest of the world here. So we've become smaller and smaller from our sort of influence on global markets, particularly in the equity and the bond space. And it just means we typically get a slower allocation. And actually, if you go back to 2006, foreigners only owned about 8% of our bonds. If you went to 2008, they only owned about 12% of our bonds. So they still hold a lot of our bonds, but they just typically hold a little bit less. We're just not as relevant. And when we often talk to foreigners about why don't they hold more of South African bonds, because our interest rates are so nice and high, they say, you know what, you're much smaller, but you've got the governance risks. They talk about the same reasons we've been grey listed, ESG reasons, as they say, but all the reasons we know. South Africa is less and less exciting in terms of, well, they can't give us a huge allocation because we're just quite small, even though we've got very attractive yields, as I'll show you in a sec. So the rand's been weak. You can see here on a couple of ways of valuing the rand on a purchasing power parity basis. South Africa's moved away from what we would see as a sort of a fair value. You can see year to date as well, we've actually underperformed other emerging markets. So while other emerging markets were weakened a lot last year and then it started recovering, we've stayed a little bit weaker. It's both a risk and an opportunity potentially, because you've got to be very cautious about just blindly taking money offshore exactly when the outlook is the weakest. Over time, these things tend to normalize a little bit. And South Africa, I think again, if we can get through a lot of the hump of the load shedding and a lot of the noise that's going on in the moment, we've just got to be a little bit cautious about chasing a trend of negativity right now. Importantly, emerging markets actually were, I showed you how the Fed earlier was way behind the curve in guessing where their interest rates are going to be. Emerging markets, and South Africa included in this, actually in the red line here, started raising interest rates way before the developed markets did. So actually the SARB, as an example, in South Africa, were very responsible and raised interest rates. We're probably going to have to raise interest rates more now, unfortunately, to keep that equilibrium of our interest rates in line with the rest of the world. But at some point, that trend should allow us, because we got ahead of the curve, to start lowering interest rates again. And we've got this interesting situation now where the real yields on emerging market bonds are still very high, where the yields on developed market bonds are actually negative. So in other words, they're giving you yields below inflation, where emerging markets are giving you above inflation. And South Africa is a good example of that. So now I'm going to talk a little bit about South African bonds as an opportunity here, because it's a good example of an asset class where I said earlier, if we get the economic forecast right, you can get the investment call wrong. And if you look at South African bonds, the best indicator of what your returns are going to be is not guessing where the economy is going to go and where inflation is going to go. It's actually the level that you buy those bonds. So if you buy bonds on 7% yields on average, your returns over the next 2 years here tend to be about 5%. If you buy them at 10%, your returns tend to be above 10%. And if you buy bonds between 11 and 12%, roughly where we are right now, your returns tend to be closer to 15 or 20% a year over the next number of years. Now, in a way, that is, it's ironic and it's a paradox, because the outlook when bond yields like they are at 12% are when the outlook is bad for South Africa. So when the outlook is good, like at these sort of levels, and actually the last time bonds were it's around 8% was actually 5 years ago during Ramaphoria. And if you buy bonds at these sort of levels, you see you actually have a far greater chance of showing negative returns. You see all these little blue dots. So if you bought at this point here, or at this point here, at this point here, your returns were quite variable. Where if you're buying bonds at a much higher yield, it actually gives you a bigger margin of safety. So ironically, with investing, often your best returns are made when things go from very bad to just bad. When you buy things when the outlook is very good and rosy, and outlook, 5 years ago during Ramaphoria, we all thought that Cyril was going to turn everything around. And ironically, that was the worst time to invest, actually. And we had actually sold down quite a lot of our exposure around that time. So just showing you on a table here that, when you typically buy bonds around the level where they are at the moment, your average return tends to be closer to 15%. And when you buy them on lower yields, your return tends to be much lower. So it's an example of an asset class that we've introduced and we've had in the portfolio for a number of years. We've got a lot of global diversified exposure, but it's an asset class that's very cheap and well priced for South African investors, as we'll come back to in a moment. So bonds tend to give you a very high return over time, simply because they pay out interest. Bonds are like a fruit tree in a way. They just they give you the fruit over time. They can be very volatile. This is just showing in the dark bars here how the capital can move around just because they get priced all the time, and the value can go up and down. But at the end of the day, the little orange dots here, yellow dots, show you what your average return was. And a good example was last year, where it was a disaster year for bonds in South Africa in general. But bonds still gave you a positive return around 4%. We did closer to about 8% in the income funds that we manage for you. So really the opportunity set is really about looking and buying and taking advantage of good opportunities in the market. And that's often the very opposite of what the economic outlook is. And let me just jump ahead. I'm worried about time here. Hugh only gave me 30 minutes. So yeah, we've got a crazy situation here. We go back to the late 90s and the early 2000s, and thereafter where interest rates here were 13% in 2002, and in 2008, just before the financial crisis, and even just after the financial crisis, interest rates were 12%. We've now got a situation where interest rates are just under 8%. At the same time, bond yields were only giving us around 8% at that time. And with interest rates now where they are, they're giving us a very high, nice forward return. So we've got an interesting example of an asset class that is giving us a much, much higher return relative to cash than it was even going back to the financial crisis time. And I'm just going to speed up and move ahead of some of these slides because it's reinforcing that same point that we're seeing that there's quite a nice opportunity set in the fixed income market. And I'm just worried we're going to run out of time. So really what we're looking for in asset allocation, we're looking for different asset classes that we can combine together both locally and globally. I like to think of the different asset classes, the risky and the less risky ones, as rubber bands. A less risky asset class is like a tighter rubber band. It tends to fall less, but it also tends to recover quicker as well. So it's a tighter rubber band, where a riskier asset class like equities or property or global equities is a stretchier rubber band. It can go down further, but then it comes back, tends to come back actually a little bit slower than the tighter asset classes like fixed income. So bonds, as an example here on the blue, tend to fall a bit less, but recover quicker, but they also tend to have a less of an upside. Here you can see SA property, SA equities, and even global equities in rands. It's not unusual over a 6-month period. This is just rolling 6 months return. It's not unforeseen to have a 20% drop in equities. It happens often around time, but it tends to recover and give you a higher return over time. And then we tend to combine that with other asset classes like bonds. And here you can see, like in our dynamic income strategy, as an example, we focus on the sort of the assets that are lower risk. They tend to give us actually sometimes even as high as 10% over 6 months. But we very seldom have got anywhere near a zero return over 6 months. So on average, we tend to get somewhere between 4 to 6% every 6 months. So that gives us a very much more confident type return than the returns that we can offer. So we obviously invested in dynamic income fund as it's the one asset in the portfolio that's providing us a very nice high yielding return. And even during times like Nenegate and COVID, we were still generating 8 to 9% returns on a 12-month basis, even during what we would consider disaster periods for South African investors. So overall, successful investing is not about forecasting the future. If anything, sometimes, knowing the future, even in hindsight, it can be very dangerous. So we've got to be careful about not only trying to forecast because it's hard, but even if you get that forecast right, you can get the market call wrong. So a lot of it more is understanding about the dynamic of markets, how well they're priced, making sure we stick to our asset allocation, which works over time. And where we've actually added a lot of value over time is actually when markets dislocate. When markets sell off quite aggressively, the outlook is the worst. That's normally the time when we like to rebalance and buy a little bit of the asset class that's fallen. And if you've got another asset class in the portfolio that hasn't fallen, you've actually got some powder dry to be able to do that. So the rebalancing and getting that asset allocation call right is very, very important. And very often those asset allocation calls are actually the exact opposite. If I told you in March 2000 that the markets were going to bottom, you wouldn't have believed me in hindsight, even in hindsight, because that was actually at the exact peak when the world was in a global shutdown. The same applied to March 2009 when we all thought the world was going into a global depression. That was actually the bottom of the market. So the key is to have that discipline as investors, to not get caught up into the hype and the noise, and to actually buy into the weakness like we've been doing in bonds actually in South Africa in the last little bit. So SA bonds as an example here, it's not a hot tip. It's more saying, you know what, it's a good asset class right now that's giving us equity type forward returns, but with better downside characteristics. But there's a reason, and there are risks to that. So they're cheap and attractive, but there's still serious global risks to consider. So that's why we remain globally diversified. We actually find that holding South African bonds, as an example, are very nicely protected by our global equity and our global exposure. And conversely as well, in an environment where the rand is strengthening, if we get into that environment, which could quite easily happen into the future, and that starts taking the heat out of your offshore returns, then we tend to have a local asset class like bonds that actually does quite well. So we always try and get the Rubik's Cube, I like to say, in some sort of equilibrium as well. You've got to be careful not to get too caught up on focusing on one side, and then you mess up the other side of the Rubik's Cube as well. So we try and keep a lot of that asset allocation in balance. We try and be very cognizant of the risks that are happening worldwide. And in the moments of greatest pessimism, look to actually rather sail into the storm and look to allocate to those sort of asset classes, because we know the rubber band tends to stretch out and then come back eventually as well. So really, I hope I've done some justice there, Hugh, just to try and give you a view, just a snapshot of what's happening around the world, because there's a lot happening out there, but the key is not to get caught up into the noise, and to rather focus on what is available from an investment opportunity, rather than caught up into the hype and the noise in markets around the world.
Well, thanks so much. I'm pretty sure I speak for everyone where we could have listened to you for a whole lot longer. So I'm sorry we had to rush you. But thanks for keeping to time. What I'm going to do is I'm going to wrap up the presentation. There are a few questions which have come in. So for anyone that is able to stay on for the questions and answers, please do stay on. We are going to be recording the session. We have recorded the session as well, so we'll send out the recording for those that aren't able to stay on and would like to hear the questions. So I'm going to share my screen again, and presentation. Hugh, could you share your screen? Thanks. So just in wrapping up, at the beginning of the year, we had a strat session and a company-wide strat session, and we touched on two very important circles, and that's it's to really highlight where we should be spending our energy, where we should be investing our energy, and we came to these two circles, and where they overlap is where we dedicate all of our energy towards, on things that matter and on things we can control. And as we said in the beginning, we believe that every single employed person within the world can achieve financial freedom within 20 years. And I'd encourage every one of us and everyone that we interact with on a daily basis to focus on these three things. First of all, to prepare a monthly budget. Understand what your budget looks like every single month, and know where you can cut or where you can splurge. Second of all, understand what your actual risk appetite is, and be prepared to pay the price for a long-term reward. And that price is a bit of volatility. It's never going to be a straight line. There's going to be a bit of volatility involved in achieving those returns. And then lastly, be in the right portfolio. Be in a portfolio where your asset allocation, we've just had load shedding here. Be in a portfolio where your asset allocation is going to get you towards that risk profile return that you're after. And then in light of all the complexity that Phil highlighted, we took a look at a snapshot of a 3-year return of all the prudential funds that are available on the market. And what would be nice is if you were right at the top. But as Brendan highlighted, if you're right at the top, it often means that in subsequent years you're going to be right at the bottom. So worry about predictable returns. Predictable returns really do matter, and they make planning really easy. And we've managed to deliver that. I'm quite pleased to say.
Switching on a light shouldn't be this complex. Neither should choosing where to invest your money. With Cinnabar Investment Management, we take the complexity out of investing, ensuring the right fund for the right investor every time. Cinnabar Investment Management. Complexity simplified.